Tonight, I come to praise activist investors, not bury them. For the longest time, I actually accepted the conventional wisdom that most activists were basically bandits. They bought stock, put pressure on management, and then hoped to catch a quick pop when the companies in question cried uncle. In recent years, though, you know what? I've begun seeing activists in a new light. Take Elliott Management, which I think is the most rigorous activist firm out there. This morning, Elliott revealed that it's taken a $5 billion position in Honeywell. That's the largest activist stake I can recall. They're urging the company break up into two divisions, aerospace and automation, which they argue could yield gains of 51 to 75%. Oh, what a monumental win that would be. And Honeywell can make it to happen simply with the stroke of a pen. By the way, I agree with Elliott. This is a terrific breakup candidate. Now, we've been big fans of Honeywell from my charitable trust for a long time. We brought it in part because the stock was trading at what we regarded as a conglomerate discount. The company was unwieldy, needlessly complicated. These days, Wall Street prefers smaller, more straightforward, nimble businesses that are easy to get your head around. Not that long ago, Honeywell decided to spin off its legacy chemicals business, focused on the company's three megatrends: aerospace, automation, and the energy transition. I applauded that move because it simplified the group of disparate businesses. At the same time, the company told us earnings would come in at the high end of their forecast. And that's why we told CNBC Investing Club members that we were encouraged by the tone of their comments. We figured that a beat and raise quarter, the holy grail that sent stocks higher, was in the offing. But we were wrong. Soon after Honeywell disappointed on sales, lowered its outlook, its stock got crushed. As Elliott's letter details, quote, Honeywell shares price has declined after each of its last 6 quarters, with 3 of these events ranking among Honeywell's 4 largest negative earnings reactions in the last 15 years, end quote. The culprit. Elliott claims that this underperformance is, quote, a direct result of a suboptimal corporate structure that has led to inconsistent operational execution, a diversified portfolio beset with numerous challenges, and the lack of a cohesive investor narrative, end quote. So if Honeywell breaks itself up into an aerospace play and automation play, you'll get a simplified two-company solution that will make the resulting business much easier to manage. I think that's undeniable. Plus, as Elliott points out, this market thirsts for pure-play aerospace company. Honeywell fits the bill perfectly. Their aerospace division dominates the cockpit for both Boeing and Airbus, both of them. That's why I welcome Elliott's intervention. We've been extremely aggrieved by Honeywell because the company lies smack in the middle of so many megatrends, but unlike its peers, it just can't seem to get its act together. And that's why I've been selling down the position for the charitable trust. Until this morning, that is. We've pretty much given up on Honeywell because of its endless missteps and excuses. At our club meeting on Thursday coming up, we intended to talk about why we were dumping the stock after a long period of frustration. But now Elliott's come along with a great plan that allows for better execution. With the smartest activist hedge fund willing to get his hands dirty, we're going to keep the rest of our Honeywell position, betting that Elliott will be able to unlock value here. Suddenly, this poorly run company has a potentially immense source of upside, as long as management takes the word of the activists rather than trying to fight them. I'd like to say, as always, a bull market summary. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.